The FDIC is broke. No, I'm not kidding. Take a look at their own website where they show you exactly how much money they have. The Deposit Insurance Fund balance is about $125 billion. That puts their reserve ratio at only 1.26%. That's right. 1.26% is the ratio of how much money the FDIC has versus all of the bank accounts that they would need to bail out should they need to do so. That $125 billion number means they didn't even have enough to bail out Silicon Valley Bank. But as we know, Silicon Valley Bank just got bailed out. So where is the money coming from? And according to the White House and everybody talking about this, it's not going to cost the taxpayer a dime. So how in the world are depositors at these failed banks getting a free lunch? Well, shocker, they're not. The Federal Reserve established something called the Bank Term Funding Program. This Bank Term Funding Program is a brand new facility the Federal Reserve just set up that is being used in order to bail out the depositors of the failed banks. And this funding program will be used to make funding available to all banks who are in the exact same position. Massive unrealized losses on their portfolio, meaning their portfolio, if they started to liquidate it, would not be able to cover all deposits in the case of a bank run. So how does this new funding program work? It will be offering loans of up to 1 year in length to banks, savings associations, credit unions, and other eligible institutions. These loans will be made by the institutions pledging collateral like treasuries and mortgage-backed securities. These assets will be valued at par. Okay, so if that doesn't make sense, here's exactly what's going on. Imagine you've got a big house, 10-car garage, filled up with cars, each worth $100,000. So you've got $1 million portfolio of cars in your garage downstairs. But you did not pay cash for these cars. In fact, you entirely financed this $1 million portfolio of cars. You got $1 million in loans. You bought 10 cars, each worth $100,000. But now the banks that you borrow that money from, they're calling you and they're saying, we want you to pay us back the full amount of the loan right now. Because in the structure of the loan, the only way that you could get $1 million was to agree to the fact that, hey, yeah, they could call me up at any point and ask for the money back. Here's the problem though. You bought these cars a year ago when these fancy cars were worth a lot more. Today, each one of those cars is only worth, let's say, 60 or 70 grand instead of the full 100 grand. So if you were to sell all these cars today, you'd be left with $600,000 to $700,000, but you still owe the bank $1 million. Bankrupt. That's exactly the position that banks are in today. They took out loans from depositors. That's what depositors do. You'd give $1 to the bank, they use that for whatever they want. They're using that as a loan from you. They owe you those dollars back. What they do with those dollars is they go buy assets. Many times it's things like treasuries, meaning they loan that money to the US government. They collect their 1%, 2%, 3%, and give you, well, nothing in return for the favor. But when they bought all of these loans last year, the year before that, interest rates were at the lowest they've been in history, meaning these bond prices were at the highest they could ever possibly be. So they borrowed money from you, the depositor, went out and bought a bunch of assets that couldn't go up in price, could only go down in price. And now when the depositors go and ask to be repaid for their loan, ask to get that money back, the banks can't sell their assets for enough to meet all the withdrawals. So how is this funding from the Federal Reserve going to change things? Because this isn't just printing money and handing it to these banks as a gift. The Federal Reserve is doing a swap. They're doing a short-term borrowing agreement between the banks and saying, hey, we'll let you have some cash, give us the collateral in the meantime. So how are they doing this in a way that's going to make the banks actually better off, at least temporarily? The assets that the Federal Reserve will be collecting as collateral for the loans will be valued at par. So you've got your garage downstairs, 10-car garage, $1 million is how much you paid and borrowed and paid for these cars. Now they're worth $600,000 altogether. So you call up your buddy at the Federal Reserve and you say, hey, look, the bank is asking me for my money back. I can't sell the cars for enough to pay them back. So here's what I need you to do. I need you to loan me $1 million so I can pay the bank $1 million. And I'll give you the cars as collateral. Now, in a normal market, the free market, any individual actor who has any skin in the game and cares about profitability or risk or anything would not take this bet, because you're making $1 million loan on a portfolio that right now is clearly worth $600,000. Would not happen. But the Federal Reserve is the entity that can actually print money and doesn't have to care about things like the plebs need to care about, like profitability. And so the Fed says, sure, I'll send you $1 million. You transfer the cars to me, and in a year, when those cars are worth more, they're back up to their $1 million mark, we'll swap back, and then you can sell those cars on the open market for their full price if you need to. Now, if this sounds a little bit like QE, you're not crazy. Quantitative easing is the practice of the Federal Reserve printing money and buying assets from the open market. They're doing so at a price that is higher than what those assets would be priced at otherwise, because they're adding new dollars, new demand, driving that price up. That is the exact purpose of QE, is to make sure those prices are higher and that the people selling those assets, that debt, can get a higher price for them. In the financial crisis, that was the entire way that they avoided a banking collapse, was by buying assets like mortgage-backed securities at full price, even though they knew they were worth a lot less. That is technically what is going on here. The Federal Reserve is temporarily buying these assets from banks, should banks need to, at full price, not market price. There is also a difference though, and the difference is that at least for now, this is still temporary, meaning that this loan is for up to 1 year, meaning that the bank is still gonna have to do something about trying to unwind this trade later. And so if they're doing this with assets that don't mature within the next year, then they still might have some problems after the year is up. Although, who knows how long this facility will be open for, and if banks will be able to continually roll over and start new funding through this that will be itself a year out. In the cars example, that situation would be like you getting to the end of the year and the Fed saying, hey, we're going to give you the cars back, give us the $1 million back. And you say, okay, I will, but I want to do that by starting up a new 1 year $1 million loan. And they just say, okay. However, if the banks are doing this with collateral that will mature within a year, then they will get that money back and they won't have to worry about the market price because it's debt and debt is repaid. And so if it matures within that year, then they'll be set and they'll be able to figure out a new way to go from there without having to worry about the market prices because they matured. Remember, with debt, if you lent $100, you're going to get $100 back. Well, you're going to get that $100 back, let's say in 1 year. So it doesn't matter during that year if that debt says it's worth $50, as long as you can wait until you get repaid. The problem comes in if you have to liquidate that debt before you get repaid, and you can only get that $50 for it by selling it on the market. In terms of the long-term ramifications of this, I will have to make a full dedicated video about this. In the short term though, many people are saying this is going to be inflationary. At this point, this alone doesn't look like it will be absolutely inflationary. What I mean by that is in absolute terms that this will push prices up. Certainly, this will make sure prices stay higher than they would have otherwise. So in that sense, you could say it's inflationary, because if this would have been allowed to play out like the free market would have played it out, meaning failure fails, and the people who deposited money at institutions that were playing dangerous games, aka all banks, and they were allowed to fail and depositors lost their money and the businesses that made those deposits had to go under as a result, we would have had some pretty epic deflation going on. Massive job loss, massive unemployment, bank failures across the nation. We would have seen just bank runs absolutely everywhere. The ramifications of this could have been a swift, severe deflationary death spiral. 100%. Prices then would have absolutely and utterly collapsed. And so you could definitely say in some sense that doing this, bailing out the depositors, which is, Silicon Valley, tech companies, bailing out these people is inflationary because prices will stay higher than they otherwise would have been, which would have been a lot lower. But in absolute terms, it's not going to be inflationary in terms of this alone won't push prices higher. This will just maintain the status quo, all else being equal. So at this point, that is the Federal Reserve's funding method in order to prevent bank runs from cascading across the nation and seeing a complete shutdown of all small and regional banks all across the country. They're basically saying, hey, any bank that needs to can get a loan from us for your collateral at full value, regardless of the fact that your collateral is not actually worth that much. Would be nice if that was available to the plebs, but it's not. So in the meantime, if you are looking for more advanced financial training, portfolio allocation, fundamental analysis for bear market investing, options trading to make money in any markets, check out Heresy Financial University, linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.